This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, I'm going to go through section B of the September 2016 paper F9 exam. And as you're aware, section B has 3 scenarios, each of them having 5 multiple choice questions. So I'll split this into 3 lectures, a lecture on each scenario. And so first of all, we'll look at scenario 1, which is questions 16 to 20. So let's have a quick read of the scenario. Herd Company is based in a country whose currency is the dollar. The company expects to receive 1.5 million euros in 6 months' time from Find Company, a foreign customer. The finance director of Herd is concerned that the euro may depreciate against the dollar before the foreign customer makes payment, and she's looking at hedging the receipt. Herd Company has in issue loan notes with a total nominal value of 4 million, which can be redeemed in 10 years' time. The interest paid on the loan notes is at a variable rate linked to LIBOR. The finance director of Herd believes that interest rates may increase in the near future. So it's 2 separate sections there. The first bit, we're going to receive some euros in 6 months' time, so there's obviously something coming about foreign exchange risk or whatever. The second paragraph, rather separate, we've got some loan notes. We're having to pay interest at a variable rate, so it looks as though something's coming about interest rate risk. Finally, the spot exchange rate, 1.543 euros to the dollar. The short-term domestic interest rate is 2% a year. The foreign short-term interest rate is 5% a year. Well, let's start looking at them and then go back where we need and look in more detail at the information. So first of all, question 16. What is the 6-month forward exchange rate predicted by interest rate parity? Well, you've got the formula. On the formula sheet, it's the last formula. That the forward rate is equal to the current spot rate times 1 plus IC over 1 plus IB. Well, we know what the spot rate is. From the question, it's 1.543 euros to the dollar. Because it's quoted against the dollar, I call dollar what you might call the base currency, IB. I don't know why they've got the symbols B and C, but since the dollar is in that sense the base currency, we want the dollar interest rate, and the dollar interest rate is the domestic rate. Their own currency is the dollar, so it's 2% a year, whereas the other country, the euro rate, the foreign rate, is 5% a year. However, be careful of just one catch here. Those interest rates are given as yearly interest rates. We're asked for a 6-month forward rate, and so we need the 6-monthly interest. So 2% a year in the dollar country is 1% over 6 months. In the euro country, 5% a year. Well, for 6 months, half of it, 2.5%. So now we can stick it in the formula. 1 plus the euro rate, so 1.025, over 1 plus the dollar rate, 1.01, gives a forward rate, 1.543 times 1.025 divided by 1.01. I get 1.566. Is that one of the answers? Yes, it is. The answer is C. So I don't think that one's too bad, apart from, watch out for things like that. It's a 6-month forward rate, and we were given, as usual is the case, we were given yearly interest rates. Let's move on to number 2. I beg your pardon, number 17. No calculations involved here, so a very quick one. As I was saying on the section A questions, ones like this, Should be very quick. You either know the answer and you tick it, or you know you don't know the answer and you guess. There's no point wasting time. However, as far as the euro receipt, what is the primary nature of the risk faced by Herd? Is it transaction risk, economic risk, translation risk, business risk? Well, the euro receipt. The reason there's risk is it's not receivable for 6 months, and in 6 months' time, the exchange rate may have changed when we come to convert or translate. The nature of the risk, it's transaction risk A. If you're unsure about what the others are, economic, translation, business, go back to the lectures, I deal with all of them. But the risk of exchange rates moving when we're converting money is transaction risk. 18, another quick one, in the sense that it's short. Which of the following hedging methods will not be suitable for hedging the euro receipt? Well, again, you should have gone through the lectures on foreign exchange risk management. We're receiving these euros. There are various methods available for hedging. A forward exchange contract. Well, that is suitable. And that you can be asked numbers directly on. B, a money market hedge. Again, borrow, convert, invest, or the other way around. That's the other standard one that can be calculations on. C, currency futures. You can't be asked calculations on futures, but you're expected to know what they are. And that is a way of hedging against translation risk. However, D, a currency swap. A currency swap is not suitable. Currency swaps are used when you're borrowing money or depositing money in a different currency. Which one isn't suitable? The answer is D, currency swap. So these balance out incidentally. 16 takes a few minutes because there are calculations involved. The 17 and 18 should both have been pretty quick, and yet they're all 2 marks. What about 19? Which of the following statements support the finance director's belief that the euro will depreciate against the dollar? And they're given 2 statements there. Statement 1, the dollar inflation rate is greater than the euro inflation rate. Now, at first glance, it's a bit confusing because the scenario we looked at has no mention of inflation rates. But it's irrelevant. This question stands on its own. It says, which of those statements would support the belief? So if the dollar inflation rate is greater than the euro inflation rate, will that lead to the euro depreciating against the dollar? And similarly, the dollar nominal interest rate, the actual interest rate in dollars, is less than the euro nominal interest rate, the actual interest rate in euro countries. Well, question 16 actually helped you. In question 16, which country has the higher interest rate? The higher interest rate, 5%, was the foreign rate, was the euro rate. So euro had higher interest than the dollar. And what's happening to the exchange rate? At the minute, it was 1.543 euros to the dollar, and the forward rate moved to 1.566 euros to the dollar. And so there is the euro appreciating and depreciating. At the moment, $1 buys 1.543 euros. Exchange rates, we think is going to move, that $1 will buy more euros. And so the euro is depreciating. If a dollar's going to buy more euros, it means the euro's worth less. And so, look at statement 2. The dollar interest rate is less than the euro interest rate. Does that suggest the euro will depreciate? Well, yes, it does. The euro rate is higher than the dollar rate, or the dollar rate is less than the euro rate, and the euro is depreciating. So statement 2 does support what they're saying. What about inflation? Well, of course, I think this was something on section A, if I remember rightly. But in theory, inflation, interest rates go up and down together. And so just as the dollar having lower interest than the euro leads to depreciating, similarly, dollar having lower inflation than the euro would lead to the euro depreciating. So dollar having lower inflation, or euro having higher inflation, would lead to depreciating. And what does it say? Dollar inflation rate is higher, greater than the euro inflation rate. Well, it's the wrong way around. We need the euro inflation to be higher than the dollar inflation to depreciate. So 1 is not true. So it does take a bit of thinking through. The correct answer, it's 2 only, so is B. I say it does take a few minutes thinking through, but rather than have to think blindly which way round, as I say, question 16, if you look back at it, did help. Assuming you got question 16 right. So. Finally, what about 20? As regards the interest rate risk faced by Herd, which of the following statements is correct? And what risk is there? It was that second paragraph of the scenario. We've got in issue loan notes, redeemable in 10 years' time. The interest is being paid at a variable rate. Normally, obviously, in arithmetic in F9, the interest is at a fixed rate, but here it's at a variable rate. So, it can go up and down year by year. We believe, or the director believes, that interest rates may increase. So there's the risk we've got. Whatever interest we're paying at the moment, we feel, if things stay as they are, that we may end up paying more interest. Well, which of the following statements is correct as regards that risk? In exchange for a premium, Herd could hedge its interest rate risk by buying interest rate options. Yes. Again, if you've read the notes, watched the lectures, you'll know that interest rate, you can use options to fix a maximum rate you'll have to pay. Okay, you have to pay a premium, but once you've paid the premium, if rates go above the limit you've chosen, you don't suffer anymore. You've got an upper limit. If rates happen to go down, then you get the benefit of the rates going down. So A, yes. B, buying a floor will hedge against interest rate risk increases. No. You see, the one I said before, you can fix a maximum rate that you have to pay using options. That's a cap. A floor would be fixing a minimum rate. Well, that's not much use. That would only be relevant if you were actually depositing money and earning interest. You don't want to fix a minimum when you're borrowing. You want to fix a maximum. C, we can hedge interest rate risk by buying interest rate futures now in order to sell them at a future date. Well, no, that won't work. Interest rate futures is when you know you're going to be borrowing money on a future date, and you're protecting against interest rates moving between now and the day we start borrowing money. But that's not what's happening here. We're already borrowing money. It's at variable rate, and that's why there was risk. So futures wouldn't be applicable. Finally, D. Taking out a variable rate overdraft would allow her to actually hedge the interest rate risk through matching. Well, that's nonsense. All right, you should have had a matching risk. You know, risk on one cancels risk on the other. But we're borrowing money. We're already paying interest. Take out an overdraft, we're going to be paying more interest. And if that's a variable rate as well, it's even more risk. So D is complete nonsense. The answer is A. We can use options to fix a cap, a maximum interest rate. So there we are. There's the first scenario. The next lecture I'll go through the second scenario.